What's up everyone, Brand the Mortgage Man here, and today I'm going to talk about a topic near and dear to every real estate investor's heart, minimizing taxes. I've helped more than 10,000 home buyers over my 20 plus year career, putting me in the top 1% of loan originators nationwide. Many of my clients are both new and seasoned investors, and it's through my experience in working with them, I've been able to help save tens of thousands of dollars in unnecessary taxes, all because of depreciation. In this video, I'll explain what depreciation is, types of depreciation, how it works to reduce your tax liability, and I'll even show you a real-life example of how it works. So let's get into it. What is depreciation? Depreciation in real estate is a decrease in the value of property over time. This decrease occurs due to factors like wear and tear, age, and obsolescence. Essentially, it's the gradual decline in the property's worth as it gets older or experiences deterioration. And this reduction in value is accounted for as an expense for tax purposes, allowing property owners to deduct a portion of the property's value each year on their taxes, helping offset their taxable income. There are two main types of depreciation. There's straight line depreciation, which is the method that evenly spreads the cost of the property over its useful life. It's calculated by dividing the property's cost by its estimated useful life. And for residential real estate, the IRS considers that useful life to be 27 and a half years. The second option is accelerated depreciation. And there's actually two types of accelerated depreciation. These methods allow for larger deductions in the early years of ownership. And the two primary types are MACRS, which stands for Modified Accelerated Cost Recovery System, and this method is commonly used for tax purposes and allows for quicker depreciation deductions, particularly in commercial real estate. It divides the property's cost into different classes with specific recovery periods, typically the 27 and a half years that's used for residential and 39 years for commercial properties. The second is bonus depreciation. This method allows property owners to deduct a larger portion of the property's cost in the year it's placed into service. This is often used for newly acquired properties or properties that undergo significant renovations. So let me give you a real example of straight line depreciation over 27 and a half years using an MACRS method. Let's say you purchased a rental property for $500,000. The IRS typically considers residential real estate to have a useful life, as I said, of 27 and a half years for depreciation purposes. To calculate straight line depreciation, you would divide the cost of the property by its useful life. So $500,000 divided by 27 and a half years is $18,181.82. This means that every year you can deduct $18,181.82 from your taxable income as depreciation expense for the investment property. This deduction helps reduce your tax liability. Now, here's an example of accelerated depreciation using the MACRS method, which assigns a recovery period of 27 and a half years. So under the MACRS method, the IRS provides specific depreciation rates for each year of the property's recovery period. Accelerated depreciation methods like MACRS allow for larger deductions in the earlier years, which can provide significant tax benefits for real estate investors, especially during the early years of property ownership. So here's an example of how that works in a 5-year period. Year 1, 32%. Year 2, 20%. Year 3, 19.2%. Years 4 and 5, 11.52%, and then the remaining years, 5.76%. So to calculate the depreciation for each year, you multiply the depreciation rate by the property cost. So using $500,000 like we did in the previous example, year 1, you would actually get to deduct $160,000. Year 2, $100,000. Year 3, $96,000. Years 4 and 5, $57,600. For the remaining years, you would continue applying the 5.76% rate until the property's basis is fully recovered, so its original purchase price. Here's an example of accelerated depreciation using bonus depreciation. So bonus depreciation allows property owners to deduct a larger portion of the property's cost in the years it's placed into service. So let's assume that a $500,000 investment property qualifies for bonus depreciation, which typically applies to new property acquisitions or significant improvements. The bonus depreciation rate can vary depending on the tax laws in effect at the time, but for this example, let's use the bonus depreciation of 50%. So Bonus depreciation equals the cost of the property multiplied by the bonus depreciation rate. So in this case, bonus depreciation would be $500,000 times 50%, which equals $250,000. So with bonus depreciation rate of 50%, you'd be able to deduct that $250,000 as bonus depreciation in the year the property was placed into service. So a single deduction of $250,000. This deduction provides significant upfront tax benefits and reduces the taxable income and lowers your tax liability in the first year of ownership versus the other options where it's broken up over time. Here are some ways that it works to reduce your tax liability. One, lowers your taxable income. So depreciation expense is subtracted from the property owner's rental income or other income generated by the property. By reducing the taxable income, the property owner owes less in taxes. It will also offset rental income. So rental income from real estate investments is typically subject to income tax, but depreciation allows property owners to offset some of this rental income, reducing the amount of income subject to taxation. Capital gains tax. When the property is eventually sold, depreciation deductions taken during ownership can impact the amount of capital gains tax owed. Depreciation reduces the property's adjusted basis, potentially increasing the taxable gain upon sale. However, this can be mitigated through strategies like depreciation recapture taxes or by utilizing like-kind exchanges or 1031 exchanges to defer capital gains taxes. Now let's talk about one last type of depreciation, component depreciation. This method breaks down the property into its individual components or parts and depreciates each component separately based on its useful life. This approach allows for more accurate depreciation calculations, especially for properties with components that may depreciate at different rates. Here's a real-life example of a component depreciation. Component depreciation involves breaking down the property into its individual components or parts, each with its own depreciation schedule based on its specific useful life. Let's consider a simplified example with three major components: building structure, land improvements, and appliances. So we'll start with the building structure. Let's just say the cost is $400,000 and a useful life is 27.5 years, just like we talked about previously. The next are the land components. Let's say that's $50,000 cost with 15 years of useful life. And then appliances at $50,000 cost with 7 years of useful life. For each component, we'll calculate the annual depreciation using the straight line method. So for building structure, annual depreciation would be the cost divided by the useful life. So in this case, we said that's $400,000 cost divided by 27.5 years. And our annual depreciation on the building structure would be $14,545.45. Now we have the land. The annual depreciation, again, is the cost divided by the useful life. So in this case, we said the land is $50,000 cost, has 15 years of useful life, so 50,000 divided by 15. Our annual depreciation on that is $3,333.33. And last, we have the appliances. We take the cost divided by the useful life again. So our cost was 50,000. We said our useful life was 7 years, which gives us $7,142.86 per year of depreciation on the appliances. So now to find the total depreciation for the property, we sum up the depreciation of each component. So total annual depreciation on the building was $14,545.45, plus the total annual depreciation on the land of $3,333.33, plus the total annual depreciation on the appliances of $7,142.86. In total, that gives us $25,021.64 per year of depreciation on this property. That allows us to reduce our taxable income by that amount every single year for this investment property, instead of using single depreciation rate for the entire property. This method provides a more accurate reflection of the varying useful lives of different components within the property itself. So by understanding the tax advantages of owning investment real estate, you'll be able to keep more money in your pocket by the time it comes for you to purchase your own. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.